Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And earnings have been flowing in thick and fast all through the weekend. So let's get straight to another earnings that did come in. JSW Energy, that stock is under some pressure. In fact, it's down more than 5%. Remember, it reported a muted set of numbers in the third quarter. The company reported a profit on a one-time tax write-back, but otherwise operational performance a little bit weakish. Let's welcome Mr. Sharad Mahindra, the joint MD and CEO at JSW Energy, who joins us on the show. Hi, sir. Good morning and good to see you in. Tell us a little bit about the numbers. What has led to the bottom line pressure? Power demand was muted. How has quarter four started, though?
Yes, very true. The current year, we have seen the demand remaining subdued. And if we see the last quarter of quarter three, the power demand has been flattish with a marginal maybe 0.1% growth only. This is, we all know, that has been driven basically primarily because of the extreme weather conditions, extended monsoons, and then also the agriculture-led demand also has been subdued. So these have been, and also the residential demand, we have seen negative growth. So all these things, but we see that this is a very temporary phenomena which is weather related, because if we see in the month of December, we have seen a really very good growth of almost 5.6% demand growth over last year December, and also the peak demand reaching a 448, one of the highest gigawatt of peak demand in December. And the trend continues in January also as we are talking. First 20 days of January also the demand growth is 6% in the country. So I think those were very temporary reasons, short-term reasons. Fundamentals remain strong. We all have seen that 2 days back, the government has come with a draft energy numbers in which they still maintain a 5 to 6% CAGR going forward next 5 years. So we are absolutely certain, as compared what you asked, our performance against subdued demand or flattish demand growth, our power sales has grown by almost 65%. So we continue to remain strong. The numbers that you see in terms of generation, in terms of EBITDA growth, which is almost 98% during the quarter over last year. So this year, the performance has been bad. Of course, with the capitalization of the assets, the interest and the depreciation part increases. And we all know that October-December period is when the wind generation is lower, and also the hydro generation also tapers off. So this is a very temporary phenomena which you are seeing. So we are absolutely certain that whatever we have planned, we are well on track on that. Nothing unusual or unexpected for us.
All right, you're saying nothing unusual or unexpected. If you could give us a sense then, how did merchant prices pan out? January ground checks and trends indicate there are some improvements. How are your realizations and what's your outlook here?
See, yes, merchant price, if we see in the current year, current quarter, we have seen 3 rupees 22 paisa has been the average merchant price in the country, which is significantly lower than what it was same period last year. But as compared to that, our merchant capacity is small, though about 8% of the total capacity is open, which is in merchant. There we have realized, as compared to the merchant price, average price of 3 rupees 22 paisa, our realizations have been almost 20% higher. And that is because of the strategic short-term tie-ups which we have done with some of the discoms and states who need power at this point of time also. So that is a proactive approach we have been taking historically, and we continue to do that. As compared to the tariffs, as you said, I'll just like to add one more line that in January, first 20 days, as I said, that the demand has grown by 6%. The tariffs also, as compared to quarter three average, has been higher by almost 30% in first 20 days of January. So this is related to the merchant tariff. Our capacity, which is 8% of the total capacity which we have in merchant, going forward from April 1st, 2026, this will reduce to 5% with most of our Utkal plant is getting under power purchase agreement from 1st April 26. So this is what we wanted to say. Maybe any other thing which if you wanted to ask, I'm ready to tell.
All right, so give us some more clarity then. Do you stick to your capacity addition plans? outline the equity debt funding plans as well. If you could split it up for us.
End of quarter three, our capacity, operating capacity is almost 13.4 gigawatt. And we are on track as we have been maintaining from the beginning to be end of the current year with a capacity of almost 15 gigawatt capacity by March 26. And the fresh capacity addition in the going forward coming years is absolutely lined up in line with the PPA timelines which we have already signed. We have large portfolio to execute in next 3 years. So we are well on track to execute the further capacities. Regarding the capital requirement, the funding, you can see that quarter three end, we have shown in our books, we have a free cash of almost in excess of 7,000 crores, which gives us a big cushion to continue with our capex plan. But as and when required, we have taken the enabling approval from the shareholders as well as the board for raising capital up to 10,000 crores as and when required to maintain and ensure that our timely commissioning of the capacities is there, and funding is not a constraint for us.
Yeah, funding is not a constraint, but you know, the promoter fund infusion of about 3,000 crores, the commitment rather, how do we read that? Any inorganic plans? I mean, what are the acquisition targets?
See, definitely, yes, promoter decided that there were ways that that the funding will be required. That was understood. That will be needing. So there were various ways of either going to the market for the fundraise, or that this is also one of the options for which we went to the shareholders through EGM and took the approval for promoter equity infusion. And promoter equity, if we see the way it is in general, what is we are witnessing in terms of how the markets are performing because of the lot of global geopolitical reasons and reasons beyond control to the sector or to the industry or to the country or maybe to any individual industry player. So I think this was, we felt that the best, it is at a significant premium what promoter has infused the equity, which enables the company to maintain the growth momentum, what we have planned in the near term. And also, it's a sign that the way companies' fundamentals, whatever we have been saying, we have been delivering, gives a confidence also to the management, to the board, that the promoter is quite confident on the board that whatever company is saying, that definitely is on track and company will be doing that. So I think this is a positive sign, which in fact market is also seeing in that way.
Well, sir, if you could help us out on ground, what is the situation with regard to the capacity addition plans and how is the tendering panning out? PPA cancellations also, that's been something that we have seen. Any curtailment in plans in the renewable energy space? What about the tendering trends?
End of quarter three, our capacity, operating capacity is almost 13.4 gigawatt. And we are on track as we have been maintaining from the beginning to be end of the current year with a capacity of almost 15 gigawatt capacity by March 26. And the fresh capacity addition in the going forward coming years is absolutely lined up in line with the PPA timelines which we have already signed. We have large portfolio to execute in next 3 years. So we are well on track to execute the further capacities. See, on ground very rightly said that there is a pendency of the letter of awards and letter of intent LOI, LOAs which have been issued. Almost 40 gigawatt worth of LOI, LOA, the PPA signing is pending. They have not been cancelled. It is that PPAs have still yet not been signed. What we see that the effect of that on ground, what is visible is two extremes we are seeing. One is that there is a very large capacity addition in the solar and wind space, primarily driven by solar, happening in the current year. If you see the kind of capacity addition which is happening in this year is very significant. It will be maybe in the range of 35 to 40 gigawatt of fresh capacity addition is expected in the current financial year in solar and wind space. But if you see the bidding in the current year, fresh bidding is only in the range of around 11 or 12 gigawatt. So this clearly reflects two things. One, that the capacities which were in pipeline are getting commissioned in the large portions, and some will come next year also, following years also, but significantly lower is what we expect, because now is the time, next 2 to 3 years, industry will be facing challenges of evacuation, power evacuation and grid connectivity, which is becoming now the grid connectivity is fresh in large numbers, will only start coming towards 2029-30. That is the time when we see again there will be a pace in terms of fresh capacity additions. So we'll see a slight moderation in capacity addition going forward, at least for 2 years. But one thing to remember, that we are insulated from this for two reasons. One, basically, that as we have said earlier, we identified this challenge about 1.5 years, 2 years back, and we opted for the sites and the PPAs with STU connected intrastate. So ISTS connectivity, which is a challenge, we are insulated, and all our PPAs and all our execution plans for next 2 years majorly is through the STU connectivity supplying to the same state. Another is the O2 acquisition, which is a 4.7 gigawatt platform, which we will be completing. Almost close to 2 gigawatt has already become operational, and we have full connectivity for this 4.7 gigawatt. Over and above that, we have additional large capacity connectivity available with us beyond 4.7 gigawatt. So as and when required, I can use this connectivity also for my future capacity expansions.
All right, we take that point, sir. But could you also give us a sense on the FY26 guidance with just 1 quarter left? You'll be better placed to tell us about that. And any early signs on FY27 with the higher capacity that you just spoke about?
See, in 9 months, we have seen the performance. We are continuing the same momentum. We will continue. Normally, we avoid the forward guidance. We will like to avoid. But yes, keeping in mind that January-March quarter is a good quarter for thermal, and also maybe for solar. Normally January March is a better quarter, and wind also, as compared to Q3, starts performing same or slightly better than Q3. So we are confident that the performance in terms of the financials as compared to Q3 will be better in Q4 is what I can say. Definitely significantly better.
Appreciate you joining in, sir. Wishing you a good quarter ahead. For the time being, the street believes that the last quarter's numbers were a little bit subpar, but you're guiding for better times. So we'll track you to those numbers. By the way, before we slip into a short break, a quick check on the markets. We were up close to under 100 points a few minutes ago. We've moved into the red. A few stocks from the Nifty that have moved down. Max Healthcare has seen a bit of a slam dunk. You have Eternal. The stock has completely lost its way, and there's a little uncertainty with regard to the leadership as well, post that change at the top. So that stock as well has moved to the low point of the day. And the big boy, HDFC Bank, I think that as well has taken a leg down. That's putting some pressure as we speak. So the Nifty in the red. But for the time being, we slip into a short break. On the other side, we have Asif Malbari, the Chief Financial Officer at Godrej Consumer, who's waiting for us. He'll discuss the past quarter's numbers.
Well, the market's extremely volatile, and no stock reflects that volatility more than Godrej Consumer. The reason why I say that is because the numbers were good. Operational beat. Yes, there was a one-off at the bottom line, but nothing to suggest that the stock would be down 5%. It's not been a big outperformer in the space either. None of the brokerage commentary reflects that there is some sort of pressure either. Down 5%, but decent numbers coming in on the company. Asif Malbari, the Chief Financial Officer, joins us now. Thanks a lot, Asif, for joining in. The street is a little worried about trade and demand environment. Could you give us a sense on how that has been post the entire GST transition, and whether Q4 will be a lot better than Q3, where you displayed about 9% volume growth?
Yeah, true. So I think from a demand environment perspective, I think broadly the environment has remained same over the last couple of quarters. Having said that, in Q2, we did have a bit of a GST disruption. It started to kind of settle down somewhere towards December. The primary category which has been impacted has been soap for us. But with the lower GST rate, reasonably confident that we should see a sequential improvement in the demand condition for soaps into Q4 and going into next year. I think there are two pieces which will benefit the soaps category. One is the lower GST rate, and second is some kind of normalization in the oil prices. Oil prices are kind of now a bit more range bound, and I expect it to be that way. So I do see sequential improvement in the demand conditions, and hence we should see some bit of, I would say, growth improvement going forward as we go along.
All right. Would you be able to put a number, though, to that incremental growth that you're talking about?
See, by and large, we have been delivering on a YTD basis growths which are in the range of 6%, 7% band. This quarter has been exceptional. We've kind of delivered in India close to 9% underlying volume growth. To me, on the 6% kind of growth rate, we should start seeing a few pips of improvement as we get into next year. Yeah, our North Star is to kind of get to touching 10% kind of growth rates. And hence sequentially kind of moving up from the 6 to get to there is where our actions will kind of span out.
All right, you've spelled your North Star out. 10% volume growth is what you want to get to. We'll talk about that in just a bit. But your last few quarters, the fabric wash and home care products business have been big hero categories. You've also launched a new toilet cleaner now. How big are these categories? What's the aspiration here? And you've disrupted definitely the liquid detergent category as well. So what's the size?
By name and also by numbers, it's been received very, very well by consumers. We've kind of scaled it up very well. The category is a category which has a big runway to growth, and hence we're very, very happy the way Fab has worked out in the market. The runway to growth is quite large because it's still a small category in terms of liquid detergents and is growing at a very fast pace. So we should start seeing growth sustain over the next couple of years. We have just test marketed Spic. It's been launched only a few months back in TN. So still early days. We're happy with the initial response. And as we kind of read more into it, we'll decide how to take the trajectory forward.
All right. And what about household insecticides? Any new inroads that you've made with the new molecule and products that you've launched?
That's right. So I think good feedback, Mangalam, in terms of how HI is kind of spanning out in terms of consumer acceptance. We are gaining market share in all segments, be it in terms of electrics, be it in terms of incense sticks, be it in terms of other products. And hence overall, it's been a good run in terms of acceptance of the product by consumers. So I think by and large, a good run, products been well accepted. And we continue the growth journey from here on.
Asif, what are some of the challenges that you're facing now in India as well as Indonesia? If you could give us some bit of a sense.
No, so I think India business, there is always some bit of volatility in terms of weather, etc. And we have some two categories which are seasonal. So it's good to kind of read things over a YTD basis or over a year basis. I think we've had a growths which are in the 6 to 7 range, which is quite strong, and revenue growths which are obviously a few bips ahead. So happy the way growth's kind of turning out in India, and I think we will only keep sequentially building from here. I think moving on to the international geographies, Indonesia has been range bound in terms of both top line, bottom line. We've seen early green shoots in this quarter where the underlying volume growth actually kind of came in at 5%. We do believe that going forward in FY27, Indonesia should start getting into top line and bottom line growth. So I think that would be my take on Indonesia. If I had to kind of talk about the other markets, we've had a very strong run in Africa, US, Middle East. It's now the 11th quarter where we've had strong profit improvement and pretty much the fourth quarter in terms of very, very strong growth. So I think that cluster has been doing well for us.
Right. And what about margins? After a very long time, they came in this 24 to 27% normative range. Is there any further upside or they stay in this range from here on?
Sure. So I think it's been a great journey in terms of margins in this quarter. we have brought margins. The India margins did kind of come close to 25%. We're very, very happy in terms of the underlying reasons for getting into this margin. There have been a lot of efforts in terms of cost savings, in terms of supply chain, in some heads, in terms of media, in some other costs. And hence, we do believe that the margin story is sustainable and we should be able to kind of sustain a range-bound, margin journey between 24 to 26. Again, we typically kind of hold our margin guidance for the year because from a quarter-to-quarter perspective, depending on the investments you're doing, depending on launch plans, they do kind of fluctuate. But we are quite confident to kind of holding margins in this range. We also guided in our press note that we do see margins stay in Q4, again, in these levels of range bound. And from there on, we should be able to build. Given that our focus has been in terms of driving a profitable growth, the idea more than margin is to kind of ensure that we kind of drive top line. Wherever we get savings, we do kind of invest them in terms of building new category TAMs. And and we do kind of, I would say, a measured margin improvement.
Got it on margins, but should we expect double-digit volume growth shortly, maybe 2 or 3 quarters away?
I think the idea is to sequentially kind of build from where we are. I mean, as I said, volumes at kind of 6 is what we've kind of been able to kind of deliver for a while. Revenues are somewhere around that 7 to 8% in India. I would say we should keep adding and improving this journey by a few bips as we go along. And as we keep expanding our TAM and as some of these new age categories start becoming bigger and bigger, the growth stack up will automatically come. So I wouldn't kind of say that a few quarters away, but hopefully in some time we should start getting to those levels of growth.
All right, sometime in the next year, you will get to double-digit growth. We wish you good luck for that. But today, the street has a different mood. The stock down about 5.5%. Maybe they expect demand conditions and your performance to improve a lot more than what you've actually reported. Take a short break, come back, get you more on the markets and a lot of stock-specific action. Stay with us.
Wibbly-wobbly trading session continues. The Nifty has now dipped below that 25,000-odd mark. It's important to defend that 24,900-odd mark. Remember, today is the monthly expiry as well. So that's what will add some more spice, not that we're short of it. But for the time being, the broader markets as well under some pressure. We'll wrap up on this edition of Chartbusters. The team of Trading Hour is waiting by. Stay tuned.